Well, well, welcome back to the nightly relay. We had a long hiatus, but I wanted to get a fresh start after we returned to um, Eastern Daylight Savings Standard Time, which we did yesterday. So, starting this around 4 o'clock in the afternoon, and now it's actually 3 o'clock in the afternoon, but it's actually 4 o'clock in the afternoon. Take your pick. So many things have been happening lately, and today was a big day in the news. Got a lot to talk about. The stock market, the Dow Jones Industrial Average, dropped more than 2,000 points today, and there were a couple of things that caused that. Coronavirus, or as it is also known, COVID-19, is causing quite a stir. Walmart stock is up because they're selling hand sanitizer and toilet paper and cleaning supplies, so you can disinfect your apartment or wherever you need to disinfect. So I don't know really where to start. It's confusing. I'm kind of like I'm acting in my mind as kind of like the stock market today, up and down, back and forth. So you had coronavirus, which is causing a panic on Wall Street, and you also have yesterday a little tiff, a little rift between Saudi Arabia and Russia, who are two of the world's largest oil producers, and oil demand has been going down. Saudi Arabia wants to flood the market with more oil for whatever reason, and Russia refuses to play along with them and us and everyone else. So instead of going along with Russia, I'm getting confused. I don't know who's trying to do what. But anyway, Saudi Arabia is going to flood the market with cheap oil. Russia says they're not going to cut their output, and so now the price of oil has tanked, gone down, and that combined with coronavirus is causing panic on Wall Street, and the stock market tanked again today by 2,000 points. So I'm not really sure what to say about all of that. First of all, I will say this, that the stock market had ballooned and bubbled up really, it was overpriced and oversold, and all those words that you can use to explain it. It had almost hit 30,000 points back in mid-February, and since that day it has dropped by about 6,000 points, which is that's a pretty huge size. That's a big chunk of what it was worth. So what to make of that? I mean, there are lots of things to make of it. One of the things I wanted to point out about the stock market, I want to try to also talk about coronavirus a bit more, and the Democratic primaries, which since I last saw you, we're now down to two candidates, Bernie Sanders and Joe Biden. How did that happen? I don't know. But anyway, back to the stock market. I mean, it's real easy to get distracted these days. So, in a response to what happened, the stock market plunged right off the bat, and it had to be halted because it dropped more than 7%. That was around 9:30 this morning. And in response to that, the New York Federal Reserve, and this is off of Fox Business, New York Fed raises repo limits to ensure ample supply of bank reserves. Now, I don't want to get too, wonky with this, but the repo market and the amount of money in the repo market has been actually a bit of a news story that's been kind of under the radar for the last 6 months. Back in September, the Fed stepped in and started flooding this repo market with hundreds of billions of dollars. They said they were it was only short term, but it apparently now is turned into an everyday thing. They announced today that they're going to pump, I think, $150 billion in immediately, and another, $100 billion from 150 billion. They'll increase it to 150 billion from 100 billion, and the 2-week operations on March 10th and 12th will increase to 45 billion from the current level of at least 20 billion. So that means the Federal Reserve, the New York Fed, is pumping close to $200 billion this week into this repo market. But they've been doing this since September, and nobody's really been paying attention. What happened back in September was that what repo means is it's a repurchase agreement. So the way that works is that usually the banks participate in this. Somebody say they want to borrow money for a short-term operation. It could be, just a couple days, or it could be a couple weeks. So as collateral, they hand over to the lender, let's say, a treasury bond, and they agree that at the end of the term of the loan, they will buy that bond back from the holder of the loan, the lender, for a bit more than they sold it to them in the first place. So basically, the bond, or whatever it is, the treasury note that they're handing over, the lender gets some money in that transaction when they buy back the bond at a higher rate. And so that's how the lender makes their profit. But then the entity that sold the bond to get the loan, the short-term loan, gets a whole bunch of cash at pretty much a very low rate, and they get to use that cash. And that's basically it's a vehicle that you're supposed to be using. Let's say you're a big corporation and your bills are due, and you got to pay off a bunch of people at the end of the month or the end of the quarter or whatever, or you have to pay taxes, and so you need cash real fast. Now you're going to get cash back later, maybe in a 2-week period or something. You're going to get some cash back. So so that you take this loan out for a very small percentage rate, and the repurchase of whatever you turned over is where the term repo comes from. So this market back in September, all of a sudden it went askew. The banks were no longer putting money into it. The big banks like JP Morgan Chase, Bank of America, and the other big banks were withholding hundreds of billions of dollars from this market, and it was causing the rates to go up to like 10%. So the Fed stepped in because you can't have these short-term rates at 10%. That makes no sense, you know. You might have a credit card with a lower rate than that. So nobody's going to want to borrow this money or isn't going to be able to afford to borrow this money. So in order to force it back down to like 1%, 2%, the Fed stepped in and said, all right, if the banks won't do it, we will do it. There's more to go into about that, why the big banks were withholding their money. That's maybe for another show. But anyway, the Fed stepped in and started doing this in September when it went off the charts, this repo rate. And now, as a short-term fix for what's happening with the stock market, they're going to put even more money into the system. So this is hundreds of billions of dollars. And, everyone thinks, stock market's been, doing relatively very well in this 6-month time frame. And the economy seems to be doing well. So why would the Fed and the banks, why would the banks not want to participate in this? And why would the Fed feel the need to jump in and rescue this to the tune of hundreds and hundreds of billions of dollars? Well, oddly enough, it is tied directly to the stock market. As soon as the Feds announced that they were going to do this the last time, the stock market skyrocketed up and went up towards 29,000 points. And now here we see as the stock market crashes back down, although it's been going up and down by 1,000 or 2,000 points quite frequently. Last week we had like a 3,000 point swing or something like that. It went all the way up to 27,000 and now it's back down to 24,000. But if you do reading on this, on what the repo market is being who it's being utilized by, you find that it's hedge funds. And hedge funds, first of all, most hedge funds keep their money offshore, like in the Cayman Islands, so that nobody can know how much money's there and they don't get taxed. And it's a very secretive, what they call a shadow bank. And the hedge fund managers then take that money from the hedge funds and they do all kinds of things, like they participate in speculative buying in the stock market. So they get a hold of this real cheap cash. Now it's coming directly from the Federal Reserve. There's plenty of it out there. They're jumping in and jumping out of the stock market really quickly. So that by itself is going to cause wild swings. When you throw into the mix that the hedge fund managers also like to do short selling, which means basically that they're betting on the stock going down in order to make money. It's a whole other thing I don't want to get into an explanation of, but short selling is basically you borrow a stock when it's high and then you give it back when it's low. So you pocket the difference. In other words, if you borrowed at $100 a share and then it comes down to $50 a share, you actually get to pocket that $50 difference. That's a very crude explanation of what short selling is. But hedge fund managers like to short sell. So all of these wild swings that you're seeing in the stock market, if you ask me, it's directly tied to what's going on with this repo market, what's going on with hedge funds, and basically people just trying to manipulate the market in order to make some quick cash in very large amounts. So, I think then again, that could be a whole other show, and maybe tomorrow we'll talk more about the Democratic primaries. I think there's 7 of them. I know one is in Michigan, which is one that Bernie Sanders won last year. So we've got Bernie pitted against Biden now. And also we're going to talk more about the coronavirus. And later in the week, we'll have some beer reviews. I'm Paul. This is the Nightly Relay. See you soon.